Hey everyone, welcome to The Explainer. I'm Steve, and we are jumping straight into the absolute mechanics behind the violent market action we've been seeing. We're going to break down the data, read the tape, and figure out exactly what this insane volatility actually means for your capital. Because let's be real, the market doesn't care about your feelings, right? It only cares about the math. So let's get to work and open the ledger.
Here's our top-down roadmap for today. We're going to start by looking at the post-holiday relief rally. Then we'll check out the yield pressure valve, weigh the geopolitical friction, break down the bull versus bear outlook, and finally, we'll wrap up with some professional trading directives.
All right, part one, the post-holiday relief rally and its cross-asset cross-currents. Let's get right into it.
So midweek trading is really serving up some intense action as post-holiday volume comes roaring back. Just look at these numbers. You've got S&P futures pausing their momentum right around 7,529. Spot gold is taking a pretty sharp reversal, and Bitcoin, well, it's kind of unraveling its bounce, dipping back under that 77,000 mark. But honestly, the thing you absolutely need to be staring at is that massive 3.1% drop in Brent crude. The entire global complex is taking its cues from that single move.
Yeah, Brent crude flushed all the way down to 93.63, and why did that happen? Well, it's because paper traders are out there aggressively trying to front-run shifting headlines. They're buying into this relief narrative, trying to catch momentum on the daily timeframes. But here's the catch, and this is super important. This move absolutely did not happen in a vacuum. If you want to understand the true structural driver of today's tape, you have to look under the hood. This drop was directly fed by a macro relief valve. Which brings us to Section 2, the yield pressure valve and the fixed income weight.
Let's jump over to the bond market because sticky inflation is creating a monumental structural shift over there. Listen, you simply cannot trade equities right now without watching the fixed income desk letting off pressure. The magic number here, 5%. Risk-free government bonds, specifically I'm talking about the 30-year U.S. Treasury yield, are pinned at multi-year highs, paying out north of 5%. That is acting as a massive restrictive weight on the entire market. It is literally forcing a fundamental reassessment of every single equity valuation out there.
And that brings us to the equity risk premium, which is getting aggressively compressed. Simply put, investors are getting paid significantly less to take on stock market risk. Think about it. When you can get over 5% totally risk-free, the S&P 500 becomes incredibly vulnerable to a sharp valuation correction. And yeah, that's despite all those massive secular AI tailwinds we keep hearing about. The reality is, if yields don't cool off soon, the sheer weight of these borrowing costs is going to eventually override any paper momentum we're seeing in stocks.
Okay, moving to Section 3, geopolitics and the tape. Let's talk about the friction in the Gulf.
We absolutely have to pivot to the physical friction points near the Strait of Hormuz because these geopolitical powder kegs could literally tear this tape apart in seconds. This dynamic right here brilliantly illustrates the massive disconnect we're seeing. On one hand, you've got algorithmic paper money dumping oil under 94 bucks, strictly reacting to ceasefire rumors. But in physical reality, shipping lanes are high risk, marine capacity is extremely tight, and global oil inventories are draining fast. The paper market might swing on a headline, but that physical supply clock, it hasn't stopped ticking. And that sticky energy inflation is exactly what's forcing those interest rates higher.
Now for Section 4, the bull versus bear outlook. It's a high-stakes fight right now.
So this whole complex mix of soaring yields and escalating tensions, it sets up a totally brutal high-stakes battle. Let's break it down. The bulls, they are playing the resilience card. They're betting that steady corporate cash flows and those structural AI tailwinds can power us right through this. But the bears are warning that this is a massive bull trap wrapped up inside a structural stagflation cycle. They're pointing straight at negative ETF outflows and yield compression. Their argument is pretty simple, honestly. One major diplomatic breakdown in the Gulf sends energy skyrocketing, and it totally wipes out today's equity buyers. Finally, Section 5, Professional Trading Directives. How do we actually navigate all this volatility?
Seriously, how do we trade this structure without letting a single green candle make us sloppy? The answer is ironclad discipline. Looking at the technicals, S&P futures are holding right above the daily 20-day simple moving average at 7,500. But the real key to watch is just below that. The 50-day exponential moving average is curling up right near 7,410. Guys, that is our primary line in the sand. As long as the price stays above that 50 EMA, the uptrend is protected.
Now, contrast that with Brent crude. This chart tells a much more precarious story. Crude just sliced clean through its daily 20 SMA and is currently testing directly on its 50 EMA at this $95 shelf. This is an absolutely critical juncture. If that 50 EMA fails to hold on a closing basis, the doors swing wide open for a deeper and honestly much more painful retest of the long-term 200-day simple moving average.
If you want to know what the ultimate smart money is doing while everyone else is out there chasing intraday ticks, just look at the Berkshire Hathaway playbook. Ajit Jain made it crystal clear. Berkshire has its price locked in to underwrite marine war risk, but they flat out refuse to front-run rumors. While other insurers are panicking, Berkshire is just holding the line. They're sitting on massive cash reserves and focusing entirely on capital preservation and patience. They are more than happy to wait for the market to price the risk on their own terms.
Which brings us to this incredibly powerful quote. Sometimes doing nothing is the most aggressive trade you can make. Berkshire is perfectly content collecting guaranteed, risk-free returns while waiting for the heavy macro weight to break the weak hands. Let that be a lesson for all of us. In a tape like this, you have to preserve your capital. Keep your sizes small, keep your stops extremely tight, and whatever you do, don't force a trade that just isn't there.
Look, the ledger does not wait for latecomers. You've got to analyze the tape and trade the actual numbers right in front of you, not the headlines you just hope are true. So knowing the geopolitical powder keg waiting in the Gulf and feeling those massive, crushing yield pressures we just mapped out, ask yourself, are you truly prepared for the open? Get your levels right, respect your stops, and protect your capital. I'm Steve, and I will catch you on the next Explainer.